Hello and welcome to the Golden Thumb Rule, a podcast where we break down timeless investing principles with the people who live and breathe markets. I'm your host, Kshitij Anand, and today we are diving deep into something every investor needs: a clear, simple, powerful rulebook for long-term wealth creation. Now, joining me is someone who has spent decades decoding the DNA of great businesses. Well, his name is Sachin Shah, Executive Director and Fund Manager at Emkay Investment Managers Limited. Sachin, it's fantastic to have you on the show.
Hi Kshitij, always a pleasure being with you. Thank you so much.
Thank you for taking the time out. And well, Sachin, let me start off with my first question. And I'm sure everyone would want to know about that. If there were one golden thumb rule for evaluating, let's say, a company's true quality beyond the balance sheets, what would that be?
Kshitij, when we do long-term investing, obviously what we are looking for is a wealth creation.
Yes.
And we are looking for companies which have compounded wealth over a longer period of time. And when we say this compounding over a longer period of time, effectively we are talking about multi-baggers, right? Because if you just think about it, 25% compounded over 10 years is actually a 10-bagger, right? So something like that. So the common trait that we have seen amongst all the multi-baggers over the last 2 decades, or all the compounders that we've seen over the last 2.5 decades, one thing that really stands out, it is management quality, right? Because it is in the same industry, there are many players, but the top 2 or 3 companies, they tend to get a very large chunk of the profit pool, almost as high as 60, 70, 80% at times, right? So what is it that, the business opportunity is there for all the companies in that sector, but the managements of those companies particularly are able to capitalize that. So it is the management quality, to our mind, one of the single most factors that drives this compounding in the wealth creation for shareholders, or in fact all stakeholders.
Absolutely. And in fact, you give management integrity or quality of 40% weightage, you could say that in your equal model. Well, to start with, what is the equal model, and what is the thumb rule investors should follow to judge whether, management is actually genuinely trustworthy or not?
Thought that we had when we created this equal model, and which is almost now, I would say 14 to 15 years back, that we created this model, and over this 15 years, we've been following it like a religion, and thanks to this model, it has really steadied as well. Idea was to capture all the nuances which are not captured typically in a P&L balance sheet or a cash flow, right? So we said, what are these 4 or 5 things that we want to really evaluate when we talk about management quality? And that's when we said we want to think about management integrity, then of course management capability, wealth distribution to minority shareholders, investor communication, and then of course liquidity, right? So these are 5 key things that we have actually shortlisted. And that management integrity is basically in terms of thinking about the intent of the management towards the minority shareholders, right? And the whole thought process here is that investing is a game of probability. There is no 1 + 1 2. You just keep on reducing your probability of going wrong. Right. It's not about hitting a 6. It's just about avoiding mistakes, right? As long as you get that filters right of avoiding mistakes, sooner or later you will reach your goal. There are very basic parameters, say like promoter shareholding, right? Again, the thought process here, higher the stake, lower the probability the promoters will do something silly, particularly the mid cap and small cap. The idea is higher the skin in the game, right? If you go to see, the next would be, say, has the promoter been increasing or decreasing the stakes? We have seen many times where promoters have actually been selling significant amount of stakes, but if you go back to the heydays of IT companies, so many promoters literally brought down their majority stake to as low as single digit stakes, and which was not very healthy from a minority shareholder perspective, right? Or promoter shareholding pledged, right? We've seen in the days of Satyam, where the promoter had pledged significant amount of their shareholding, and in those days the disclosures were not available, but now the disclosures are literally updated as and when the promoters are pledging their stakes, and you know the exact percentage. So whenever there is a disproportionate pledging of shares by the promoters, to us it's a red flag, right? Promoter group salary as a percentage of profits. Again, if it is significant, like 20, 30, 40% of the profits, to us, it is again a compromise to the minority shareholders' interest. And we've seen something like this in the past, even with multinational companies, where royalty as a percentage of profits used to be a significant amount, right? Or say inter-party related transactions. These are things which are always a red flag, and we like to be cautious about it.
Let me also get your view, if an investor had to rely on one thumb rule to, let's say, assess management capability without meeting them personally, because, not everyone have the privilege like you have, you could probably go and meet the management. What should they look for in that case?
When it comes to management capability, right, what we are extremely focused is in terms of their execution side. So like, for example, a debt equity ratio, very simple thing, right? But within that equity ratio, how much is your long-term debt? How much is your working capital debt? Within that, how much is your forex debt? And if you have a forex debt, how much is your unhedged forex debt? Again, if you go back to the days of 2007, 8, 9, so many companies had significant amount of unhedged forex debt, right? In fact, they used to have FCCBs. Everybody thought this is an equity, but it never got converted and it actually became a forex debt. And with the rupee depreciation, there was a serious challenge. I mean, so many companies were exposed to these structured products and they actually went belly up, right? So that's one thing. But I think the most important thing to my mind in terms of management capability is the capital cost efficiency, right? And when I say this, it typically means that whenever a company is putting up a project, say for example a cement plant, say if they're putting up a 5 million ton cement plant, then what is the cost, capex cost per million ton for that company versus the typical industry benchmark, right? And what has been their track record in terms of their project execution, both in terms of the time and the cost overruns. But if you personally ask me, if I have to boil down all of this, then there's one parameter, and that is ROCE, return on capital employed.
Right.
If that's a very decent number, if that's a good, decent double-digit number, anywhere 15% to 20%, I think you can say management is capable as far as managing their own business is concerned.
Absolutely. We'll always track the ROCE parameter, and 15% is the ideal figure which one should look for. And yes, but it might differ from industry to industry. But yes, definitely something some benchmark to go on with. Now, let me also, get your viewpoint on the, promoter behavior. What is the golden thumb rule for identifying whether a company's wealth distribution practices such as dividends and promoter behavior are investor friendly or not?
There are three key things that we always monitor. First, as you rightly said, one is the dividend payout ratio, right? So companies like, say, Hindustan Lever, companies like Nestle, they have dividend payout ratios of as anywhere between 70 to 100%. In fact, now even IT companies have that kind of payout ratios, like 70 to 100%. Whether it is Infosys, TCS, HCL Tech, all these companies have that kind of payout ratios, right? So, which is clearly a very healthy thing from a minority shareholder perspective, because it tells you two things actually. One, the profits are real, the cash flows are there. Otherwise, we have seen so many companies where profits are declared, but there are no cash flows because they are stuck in working capital, they are stuck in something or the other. Second, it also tells you for companies like, say, Hindustan Lever, Nestle, that the business inherent is so strong that they don't really need capital for the future growth.
Okay.
Right? These are businesses which can actually grow significantly just because of the franchisee value, because of the distribution network, because of the branding, advertisement, investments, the equity, the brand equity that these companies have created. The other two parts, which is actually a red flag for us, which is where we have seen large acquisitions, So because companies have generated tremendous amount of cash flows from their existing business,
Right.
and for some reason they are not able to see, deploying. They are not able to see the opportunity of deploying more cash into their existing business. They try and do some large acquisition, or they actually go and also invest in an unrelated business.
Okay.
So these are clearly red flags for us. And what is a large acquisition? The way we define it is that if it's more than 50% of your current balance sheet size,
Right.
it's a large acquisition.
It's a lot.
So as a rule, as a thumb rule, we avoid investing in those companies wherever there is a large acquisition for at least 1 year. After 1 year of the acquisition, we revisit those companies and we see, is the acquisition actually playing out in the direction it was anticipated? And I will tell you, 8 out of 10 times it has not played out,
Okay.
right? And this is true with the largest, the biggest, the best of the companies in their sectors.
Sure.
If you go back to history, the largest steel company in this country, when they did an European acquisition, the largest automobile company when they did an European acquisition, a largest telecom company when they did an African acquisition, a largest pharma company when they did a second largest domestic pharma company based out of North. So all these acquisitions just didn't play out for years and years. They were drags on the existing business and the existing shareholders for more than probably 3, 5, 7, 10 years.
Well, actually, Sachin, very clever of you. I think you've named companies without naming them in your examples. So there's this one term which we keep on hearing, going around in media as well, in a lot of reels, which is, buy at the right price. So what exactly is the right price according to you, Sachin?
Like Warren Buffett says that rule number 1, do not lose money. Rule number 2, do not forget rule number 1.
Yes.
Effectively saying that your purchase price should be good, whichever asset class one invest. To my mind, the real thumb rule is that all the returns will be linked to whatever is your current and the future expected, the risk-free rate, right? Which is, say, for a typical individual investors, I would say, as a thumb rule, let's assume, say, a bank fixed deposit rate, right? So, say today a bank fixed deposit rate is, say, about, 6.5%, right? From that perspective, to my mind, the very basic return that one should expect from a listed equities should be at least 2 times of that, right? So which is at least 13%, right? So 2x of the risk-free rate should be your expectation as far as a very basic expectation of a listed equity. And when I say very basic, I would say this is like the top blue chip companies, right? So it's like the AAA bonds, the AAA equities, right? Because you are comparing a 6.5, which is a AAA, which is a bank FD rate, right? You're comparing it that, so you just expect a AAA stock. So all the nifty stocks or that kind of quality companies should probably deliver that kind of return. So if you just look at nifties and you say anywhere between 1.5 to 2x, it should be a basic expectation. So it should be anywhere between 11 to 13%, right? Now, as you go down further to mid caps and small caps and the smaller sizes of the companies, I think your return expectations have to keep on increasing because you want more risk premium, right? So if you can say that if this is 13%, I want 20% more premium. So 13 into 1.2, so that's about, say, 2.5%. So you can say I want about 14.5 to 16% kind of a range for a mid cap. Similarly, say if you go to a small cap, again a high quality small cap, but it's a small cap, right? So there again you will say I want probably 18 to 20%.
Very quickly, if you can help us, how to instantly spot a corporate red flag.
Say for example, we have 6 or 7 parameters where we say that if any one of them is there, then we generally avoid or we believe those are red flags. So like for example, I mentioned earlier, say promoter shareholding pledged. So what is that particular percentage? Beyond that, we don't invest. So if a promoter shareholding pledged is more than 70% of the promoter's ownership, we avoid investing in those because we have seen whenever that 70% is crossed, there has been compromise of minority shareholders' interests, right?
Okay.
So promoter shareholding pledged more than 70%, we avoid investing in those businesses, right? wherever there is a more than 50% of the business is invested in unrelated businesses in a new business, we avoid investing in those businesses at least for some time. Similarly, a large acquisition, which is again more than 50% of your balance sheet size, we avoid investing in that business for at least 1 year, right? Wherever a debt equity is more than 2.5 times, we try to avoid investing in those businesses, right? So these are some of the parameters that we are always avoiding, broadly speaking, from what I can think of. Maybe one or two. I think the other very important thing is also because our job is to do research, and to do research we also need good information, good disclosures from the company side. So wherever we see that there is no investor communication from the company side, and we have seen in many good businesses, good companies, particularly multinational companies, where they have decent amount of businesses, very good cash flows, but somehow the investor communication, even in their annual reports, is not good enough for us to understand where is this business headed over the next 2, 3, 4 years, right? So these are some of the things that we are actually focused about.
Perfect. These are valuable insights there, Sachin, and I'm sure a lot of our viewers would take note of that, and it'll help them, spot a red flag instantly. And finally, on a lighter note, we are entering a new year. So, any golden thumb rule for navigating Indian markets in 26?
Well, I would say that stick to quality. It is very important, because we have seen that when it comes to the mid-cap, small-cap flavors, the flavors will keep on changing, right? But the quality is always resilient. So if you invest in quality businesses, your portfolio will be very resilient, and as soon as there is a calmness in the market, you will again emerge much more stronger.
Well, on that note, Sachin, thank you so much for your time. Well, this was indeed a masterclass in simplicity. Well, the richest insights in investing often comes from simple rules, and you've given our listeners plenty to think about. Well, thank you so much for joining us on the Golden Thumb Rule. And to everyone listening, remember, markets may change, cycles may turn, but timeless investing principles stay constant. Thank you so much for joining us at the Golden Thumb Rule, Sachin. Thank you so much for your time.
Thanks a lot, Shweta. See you.